been doing a lot of studying of the charts this weekend, and I've kind of come to the conclusion that perhaps we aren't done with the yearly cycle low yet. So, one of the main reasons that I um, made the call that this was a final uh, intermediate and yearly cycle low was, we had the characteristic divergence on the McClellan oscillator that usually happens at these um, larger degree cycle bottoms. And then we had a pretty strong push out of that bottom. So that looked, it made this look like a final yearly cycle low. However, this rally is not behaving like I would expect a rally to behave out of a yearly cycle low. I would expect the first daily cycle would easily recover these all-time highs, and we're not doing it. So one of the things I did notice as I started going through some historical charts is that um, almost every intermediate degree decline has it forms at least as an ABC pattern. So we'll get an A wave down, then we'll get a bounce, and then a C wave down that makes a slightly lower low. And there's just almost none of these larger degree intermediate cycle lows form without at least that three wave pattern. And so while this does look like an intermediate bottom based on the McClellan oscillator pattern with the divergence and then the pretty strong move higher, it doesn't really look like an intermediate cycle low in that I don't really see a three wave pattern. I see a pretty much a straight move down into the bottom with one up day that in my opinion just doesn't qualify as a B wave bounce. And so my thought now is that this decline is the A wave. We're having a third daily cycle, and uh, that will constitute the B wave bounce. And as we're seeing this, we're getting late in this cycle. We're going to be on day 25 tomorrow. Um, and so it's looking like this cycle uh, is wanting to top before it can make a higher high, and that would be characteristic of a third daily cycle in a larger intermediate degree cycle. And then so let's say we get a little bit of a bounce between Monday and Wednesday, gives the Fed some cover to raise rates on Wednesday, and then the market uses that as the trigger event for price to drop down into the soon to be due daily cycle low. Like I said, we're going to be on day 25, so we're getting late enough that at some point here pretty soon we should start moving down into a daily cycle low. So we're kind of running out of time to test these all-time highs. And if I'm correct, this is the A wave down, this daily cycle here, this what now appears to me to probably be a third daily cycle. This would be the B wave bounce. And then if we get a sharp move down over the next, let's call it 2.5 weeks, and get a bottom maybe in this first week of April that drops below the February low, that's going to convince a lot of people that we've got a failed intermediate cycle in play, and we're going to start hearing lots of calls for a bear market. And in reality, I think what we probably have is just a very complicated yearly cycle low, and that And the reason for that is simply because we've had almost a year and a half of um, very strong trend, very mild um, corrections. Even the ICL in March and again in August, neither one of them included a failed daily cycle, which most of the time that will happen. And so we've just kind of stretched the rubber band, so to speak, really far on the mild side during um, this move out of the election night reversal. So let me widen the chart here a little bit. So here's the election night, the reversal, and just since November of 2016, we've just had nothing really scary at all in this market, and so we're paying the price for that now with a um, with what I think is going to be a stretched intermediate cycle. So instead of bottoming on week 24 right here, we're looking at maybe a bottom somewhere around week 30 or 31. Maybe, like I said, the first part of April. Here was the last um, intermediate cycle low. You can see we've got this ABC pattern. Here's the A wave down, the B wave bounce, C wave makes a slightly lower low. Same thing happens back here in March. We got the A wave down, we got a bounce. Then we've got the C wave makes a slightly lower low. Same thing over here as we move into this intermediate cycle low. First leg down, we get a bounce, rolls over, makes a lower low. We don't have that yet anyway at this February bottom. So my feeling now is that this is just going to turn out to be a stretched intermediate cycle. It's going to turn out to be a very complicated and complex intermediate cycle, but still one that's going to give us, at least a three-wave pattern before uh, the bottom is in. So even though the McClellan oscillator looks like it's saying that this is an intermediate cycle low, I think this is a false signal. And I'll show you one other time where this occurred here in a second. But my feeling now is that this is not a first daily cycle in new intermediate cycle, but this is a third daily cycle that's probably going to use the rate hike on Wednesday as a trigger event to start to move down into the next daily cycle low. And if that daily cycle low drops below the February low, then we would complete our A, B, C pattern, and that would give us a final yearly cycle low, and one that would convince most people and most other cycle analysts that we've got a failed intermediate cycle in play, and then everyone's going to be calling for a bear market. And then when stocks reverse out of what I think will be the true yearly cycle low and go on to make higher highs, that will catch 90% of the market on the wrong side of the boat. Okay, so here is the instance where we got something very similar, and this proved to be a false signal. We've got a normal duration. We got two daily cycles, very similar to what we had moving into the February bottom. This move down was at the 6-month mark, which is just about normal for an intermediate cycle. So, in real time, this looks very much like an intermediate cycle low. It broke the intermediate trend line. We have that classic divergence in the McClellan oscillator. We've got a very strong move out of this bottom. So, in real time, by the time we got to September, you know, I think everyone would have agreed this was an intermediate cycle low. We were starting a new advancing intermediate cycle, but we would have been wrong. The intermediate cycle was still ahead of us, and it occurred as a very stretched daily cycle. It's around 48 days, and as we know, most daily cycles tend to run 35 to 40 days, although we seem to be evolving, and many of the daily cycles of late have run longer than that, some even as long as 60 plus days. So I'm not really going to, adhere to the 35 to 40 day timing band that just may not be normal anymore. The normal timing band may be evolving into a longer duration, but you can see here we've got this, the kind of the classic three waves down. We've got first wave here, uh, a bounce, another bounce. The McClellan oscillator gets oversold and then starts to diverge, and then we get a move below this. I would call this the A wave, B wave top, C wave bottom. So we get our three wave pattern down into the intermediate cycle low. So while in real time this looked very convincing, the one thing it lacked was the ABC pattern, and that was the clue that this probably was not a final intermediate cycle low. And in fact, with the benefit of hindsight now, we can tell that we still had another very stretched daily cycle to go before we got our final intermediate cycle low. So my strategy this week, we've already taken profits on our TQQQ position, so we don't really need to do anything with that. Even if we do rally, into Wednesday, gives the Fed some cover to raise rates. I'm not going to worry about that too much, because we're getting late enough in the cycle that we're probably going to be due for a move down into a daily cycle low anyway soon. So I'm not going to be alarmed if we miss a 3-day rally into the FOMC meeting, because I'm afraid that this is going to turn out to be a third daily cycle that will use that FOMC meeting as the trigger event, and then begin a move down that will give us a lower low. Here's another sign, a warning flag, put it that way. During an intermediate degree advance, when stocks come out of an intermediate degree bottom, they tend to get overbought and they tend to stay overbought. And so here's a good sign here coming out of the election night. Stocks stay overbought for a considerable amount of time. Don't really move back down to oversold. Coming out of the March, ICL again staying overbought. The August ICL price stays overbought. And as we came out of this bounce, we got overbought and immediately turned back down. That's not a very good sign. And then we started back up again, and the same thing happened. We're just not staying overbought like we should during a new intermediate advance. So if I just look at this chart, this is starting to look like a third daily cycle to me. This is the S&P. The Dow looks, even more convincingly like a third daily cycle. We've got a top on day 11 right here, as of right now. If price isn't able to get back up here and make a higher high, then we've got a day 11 top, which is potentially a left translated cycle. And as I noted in that 2014 example, the market actually rallied for about 30 days and then still rolled over and produced a failed daily cycle. So, even though the S&P may, have made a top on day 21, I think, or if it makes a slightly higher high this week, it is still possible for the cycle to roll over and produce a failed daily cycle and move below the February low. So looking at the Dow, this does not look like a first daily cycle to me. This looks like a third daily cycle. And so the one bright spot is the tech sector, which has made a higher high, but that still doesn't eliminate this from possibly being a third daily cycle, or it could be a first daily cycle and the Nasdaq just shows some relative strength and does not move below the February low. There are times where the indexes will not confirm each other, and I think there's a decent chance that could happen here. The S&P and the Dow could maybe move below the February low, but the Nasdaq does not confirm that and holds above this February low. We are, however, seeing a rising wedge pattern. Not a big fan of chart patterns. I've seen too many of them over the years, either just not play out or they morph into something else. But um, I'm gonna kind of take this one seriously simply because I'm starting to get the feeling that we're in a third daily cycle in the Dow and the S&P, and if those two indexes were to break down, complete a C wave decline, then you would have to think that this rising wedge would then break sharply lower in the Nasdaq, and we would probably at least get a daily cycle low, maybe that first week of April, along with the what I anticipate could very well be an undercut in the Dow and the S&P. So my plan for next week, as long as things continue to play out like I'm expecting, I really think we're probably going to get a rally the first part of the week to give the Fed some cover to hike rates again. And I suspect that's going to be the trigger to start the market moving down into its daily cycle low. So if that is the case, and we do get a rally, maybe we come up to tag this upper trend line of this wedge, then I am going to take profits on both of the Quest positions. I don't think I'm going to do anything with the aggressive portfolio position in the DIA. We're going to be down 50% on that position, and we've still got plenty of time to let that play out. And if I'm right, and we do get a final yearly cycle low as an undercut, then you would think the next daily cycle would do what daily cycles are supposed to do, and the Dow would, get busy. Let me switch this over to the chart of the Dow. Okay, so I like I said, I don't think I'm going to do anything with the aggressive portfolio. We've got plenty of months left on that position, and if this does turn out to, come down and undercut this low, and that turns out to be our real yearly cycle low, then you would think the next daily cycle would behave as daily cycles typically do, and we'd get a very strong push back up, and it wouldn't be long before we're back making new highs. And we've got all the way out to September, and I would suspect if we get a bottom here in let's say the first week of April, well, I would think easily by May the Dow would be back up making new highs above this level. So at this point, I don't think we need to lock in a 50% loss on our DIA position. We've got lots of time on that. This is exactly why I bought all the way out to September. So in case we did have to weather just a more complex intermediate cycle low or a deeper one than we anticipated, we would have time to do it. So, even if this was to go down and take out this low and our AP position goes to down 80 or 90%, I think we've got plenty of time, and the market should easily recover all that, uh, because I think by May we would be back making higher highs in the Dow, as a the next intermediate cycle should behave like a true uh, advancing phase of an intermediate cycle should behave, and it should quickly come back up and regain these highs. So stay tuned. We'll see how tomorrow plays out, and then Tuesday and Wednesday as well. If I see that trend line tagged, or if I just start to get nervous and decide that I want to get out of those quest positions and take some profits, I'll send out a portfolio change. We'll take those profits on that position, and we got some pretty big profits. And if we do get a deeper ICL, then we are going to be in a very good position to accomplish our goal in the quest, or come fairly close to it, if we can get out pretty close to the recent top and then get back in, at a much lower. All right, so here's the chart of the Qs. So let's say we bounce till Wednesday and we come back up, we test this, or maybe go a little above 175. Probably if we get to 175, that would probably be good enough for me, and I would go ahead and take the profits on our quest. Our original quest would be somewhere between $15,000 and $17,000, and that's a pretty respectable profit from an initial investment of 1,100. And then if we do get a sharp break lower and we get a bottom maybe somewhere down here around 150, or maybe we even get an undercut and we get down here in the 140s, and we could re-enter that quest position down here at this level, and then we get our run towards 10,000. I would say we would have a very good possibility of completing the goal and getting that initial quest position up to or very close to the $100,000 goal during the rest of the year.